Hi, I'm Simon Lambert. I'm the editor of This Is Money, the financial website. And today I'm here to talk to you about diversification, which is about how to make your portfolio less risky. Basically, it might sound dull, perhaps. Asset allocation and things like that do tend to be the words that tend to make people's eyes sort of glaze over when you talk to them about investing. But actually, this stuff is really important. And I'll explain to you the reason why. So in the more than a decade that I've been writing about investing, I think I've encountered, many investing stories from people, professionals and private investors. And there's two things that really stand out, I think, as comments that I often get. One of these is, I dived in too quickly, I didn't do my research, I was afraid of missing out. This is the classic scenario that I guess many people might recognize. They see a good idea, they see a stock on the move, they read a share tip, and they think, oh, I'll have some of that. Oh, look, it's moving up. I don't really have time to do any research. I'll just buy some. And then the other thing that I hear quite often is, I thought it was going to be big, and I could make more money by investing more. Something's going up, people think, they read the tip, they get the idea, they think that is an absolute surefire winner. I'm going to put £4,000 in, not £1,000. Now, the problem is, what happens quite often, is that not doing that research or putting too much money in backfires. And when that stock sinks, you end up with a big loss in your portfolio. And those losses are the kind of things that can really dent your investment returns over the years. So what can you do about it? Well, what if there was a solution to both of those problems? Well, there is, in essence. Don't put too many eggs into one basket to diversify. By spreading your portfolio across a reasonable number of shares and things that do different things, and asset allocating, you can make sure that if something does go wrong, then it won't hit you too hard. And you can be sure that something will go wrong, because as we know in life, oops, bad things happen, just like that. So there's some classic examples here. We have the story stocks that can suffer. At the bottom of the screen there is the share graph of Quindel. Now, Quindel has been one of those classic story stocks. And I guess there's probably many people here who might have invested in Quindel. I actually had some Quindel shares at one point, and I lost money on them. And the problem was with Quindel is that it just looked so good. They looked to be making so much money. The profits were going up, and people looked at it and they thought, right, I need to get in. I need to get in. I need to buy because this stock's going to the moon. It's going to make me a fortune. And then when it came crashing back down to earth, one of the comments that I read very, very often in a lot of forums and bulletin boards and things like that was from people who said, I'm in real trouble here. This has lost me a lot of money. I can't afford to lose this money. And a lot of people had put too much of their portfolio into Quindel, which ultimately was a growth company. It was a risky company. And instead of maybe putting in 5% of their portfolio, or even at a push 10%, there was people with 25, 30, 40% of their money invested in this company. And what happened is there was a piece of research that came out from a rather mysterious and shady organization that suggested the figures weren't up to much, and the share price crashed. And it did turn out, actually, that those figures weren't up to much. And I feel very sorry for anyone who has lost money in that way. But it's not just those story stocks and those small companies, those growth companies, that bad things happen to. It also happens to safe blue chips. BP, exactly the kind of big blue chip income-paying share that people would look at and go, that is a nice cornerstone of my portfolio. That's the kind of thing that's going to pay for my retirement. I can put my money in there and I will be absolutely fine. And then all of a sudden, there's a disaster in the Gulf of Mexico and you've lost a load of money. Now, the problem is that if BP is just one of a number of shares in your portfolio, then you can take that hit, you can ride it out, you can chalk it up to experience and say, look, I couldn't possibly foresee that there was going to be this disaster in the Gulf of Mexico. This is not my fault as an investor. There's no way that I could have predicted this was going to happen. But bad things happen. And by only making it a small part of my portfolio and not relying too much on one thing, I can chalk that up to experience. But if you've got 25, 30% of your portfolio in BP and something like that happens, then you're in real trouble. And that's a safe blue chip stock. And sectors can also suffer very, very fast. I mean, who here would have thought that the supermarket sector would have started to struggle and suffered so much so quickly? I think with the benefit of hindsight, we can all turn around and go, oh yeah, well, Tesco's been treating its customers badly for ages. Yeah, I was never quite happy with it and all those things. And yeah, I don't like the supermarkets. Yeah, I definitely prefer to go to Aldi. Yeah, it's much easier to not have all that choice and stuff like that. But there wasn't really that much of that going around before the supermarkets really went on the slide. And it's hit every single one of those really hard. And actually, as they were falling, people were looking at these companies, looking at companies like Tesco, looking at companies like Sainsbury's, looking at Morrison's and saying, this is too cheap. This is too cheap. This sector's going to come back. And, you know, it's risen, it's fallen, it's been a good trading opportunity. But long term, they're in that downward trend that was spoken about just now. And they are suffering. And again, these are big name companies. Another classic example is the banks in the financial crisis, where, you know, I feel very, very sorry for a lot of those people who were heavily invested in banks, especially the people who worked for banks. And we heard a lot from them in the aftermath of this. Many people who worked for the banks and had a lot of their wealth tied up in HBOS shares or in RBS shares, and they really suffered. And so it's really important, I think, to think about these things from the point of view of how much could I take that loss? How much would I suffer? But there's another reason to diversify, and that's not just because of the doom and gloom. It's because good things happen too. Diversification is not just about avoiding losers and dodging those things that are going to make a massive hole in your portfolio. It can also help your chances of picking a winner too. If you've only got 5 shares, then you're relying on one of those 5 shares doing really well. If you've got 20 shares, you are spreading your chance across more companies of doing well. So the first point to make on diversification is actually not just about shares. And I'm going to guess that, as most of you are here at something called the stock market show, that you probably like investing in shares. Is that a reasonable assumption, figure? But it's about asset allocation. It's about investing across asset classes. It's about shares, bonds, and cash. So why do we do that? Well, we do that because basically, if you look at it long term, look at the chart, well, shares do better. So why not just invest 100% in shares? Surely that's the best idea. Well, as we know, the stock market suffers from time to time, and holding bonds is a counterbalance against shares, and holding cash is the safest thing of all. It will be eroded by inflation over time, and it's not the way to grow your wealth, you know, long term, but it is safe. You put that money into a protected deposit account, and it is safe. Then you've got the other assets that you might want to sprinkle in: property, gold, and commodities. So how should you divide your money up between these things? Well, that's a pretty difficult question to answer. There's a number of rules of thumb on this. Some people say, oh, hold your age in bonds. The great investor Benjamin Graham said that you should go for 50-50, but you should move as far either side as 75-25 either way, depending upon market conditions. Essentially, you should be looking at what's going on and asset allocating. Now, my personal view at the moment, and the view of a lot of people when looking at this, is why are you telling me to invest in bonds? Bonds are really, really expensive. Haven't you heard about this thing called quantitative easing and ultra-low interest rates that's driven bond yields down to record lows, and bond prices up to highs, and the whole thing's going to blow up and it's a massive bubble? And I probably agree with quite a lot of that. But what's happened since April this year? The stock market's sunk and the bond market's done all right. So you can see that this is a great example of why you should have that counterbalance. Now, I would probably err at the moment more towards holding money in shares. And also, ultimately, it's a personal decision. It depends about your own appetite for risk. And your own appetite for risk is only something that you can assess. So it involves, how would you be hit if you lost money? How much risk are you willing to take to get a reward? But also other things like, how secure is your income and your job? How long have you got left working? How many years do you have to make up those losses? What other assets do you have elsewhere? So if I use myself as an example, I've got I'm in my mid-30s, I've got at least another 30 years worth of working ahead of me. So I've got a very, very long time to be earning money and hopefully make it. If I make a loss, I've got a long time to be making back that loss and a long time to be investing. You know, I'm investing every month into my pension. I invest as a personal investor. So I can basically take a risk and mainly hold shares. I don't need to worry too much about that counterbalance because I know that over that really, really long-term period, you know, even if I get unlucky and I buy in right in at the top now, hopefully over that long-term period, it's gonna be up above that. But if I was looking at this and I only had 5 years to retirement, or I was worried about the security of my job, or potentially I had a very, very big mortgage, or I knew that I had heavy expenses, well then I'd have to take a lot less risk because if I lose that money, I could be losing money that I really, really need. So that's something to think about when you're trying to weigh up how you balance your risk and how you asset allocate. And the thing that I would say to people about this is go off and do read about asset allocation. There's a lot of stuff out there on the internet. There's a lot of stuff that's been written about it. And have a think about the different models and the different ways that people suggest doing things. And then decide what you want to do. And it's about building a winning team. Basically, that England World Cup winning team, it didn't win the World Cup because it was a team of 11 strikers, did it? It won the World Cup because it had different individual players who all did different things. And think of your portfolio like that. So now, to the bit that you all want to talk about, shares. How many shares should I hold? Well, that bloke on the left-hand side, you might know him, he's quite successful. That's Neil Woodford. He holds 96 shares in his portfolio. And the bloke on the right-hand side, Nick Train, another very successful fund manager, he holds 25. So which of them is right? Well, according to Ben Graham in The Intelligent Investor, there should be an adequate, though not excessive, diversification. This might mean a minimum of 10 different issues and a maximum of about 30. So does that mean that Nick Train's right and Neil Woodford's wrong? No, it doesn't. Why does Neil Woodford hold 96 different shares? Neil Woodford holds 96 different shares because basically he invests in large income-paying companies, but he also does quite a lot of investing in small-cap companies that are quite risky, early stage, small cap, startup, growth companies. And so he holds a very small amount of his portfolio in those shares. And he'll tend to build up that portfolio, make that initial bet and then build it up. And the other thing is, Neil Woodford has an entire team of analysts and people working for him doing research and looking at these companies and monitoring these companies. So Neil Woodford can reasonably have a reasonable expectation of keeping his eye on 96 different companies. Nick Train, on the other hand, thinks that basically you should have a more focused portfolio, and he invests in brand-type companies. He's dubbed Britain's Warren Buffett, companies with a moat, those long-term companies. He's going to buy and hold them forever, and he's not interested in nibbling around at all these other companies. As a private investor, I know that I certainly couldn't keep an eye on 96 companies. No way, absolutely not. And I think that that is far too many to be keeping an eye on as an individual. I do think that Ben Graham, about 10 to 30 is right. I think Nick Train's number is probably right for an individual, maybe a few less. And there's some academic studies that we can see into this. So how many shares should I hold? Right, this is a famous study that was done by some people called Elton and Gruber in 1977. Now, what they did was they looked at standard deviation, which, to not go into too much jargon and geekiness, is basically a way of looking at how likely a share is to make a big loss or a big gain in a year. And then they worked that out into risk. And that chart shows the risk from holding different numbers of shares. And the maximum number of shares they looked at was 3,790. And they went from holding one share to that. Now, you look at the risk if you're holding one share. That's pretty high. 2 goes down quite a lot. 3 goes down quite a lot more. 4, goes down quite a lot more. 6, 8. But once you get to 10, that risk has really, really, really substantially dropped. So that shows the advantage of spreading your risk across at least 10 shares. It does continue to go down. So this number is quite often said about 15. Actually, if you go above 15, it does still continue to fall. But the increments of those fall are much, much smaller. And so you can see the curve bottom out there. And you can also see in these numbers here how the risk score that you've got there, going from 10, you have a risk score of 11, down to 20, you go down to 9. But then if you go to 50, you only go to 7.85. And at 3,790, you only go to 7.07. So realistically, You actually don't need to be holding that many shares to make a serious difference to the amount of risk that you're taking. So what do you need to do when you're choosing these shares? You've chosen your number of shares. Well, what do I put in there? Well, the one thing I'd say is beware a portfolio that's all the same trade. So you need to invest in shares that don't all move in the same direction, basically. There's market cap. Are you just investing in small caps? Are you investing in mid caps? Are you investing in large cap shares? Sectors, the geography. Not necessarily where that company's based, but where does that company do business? Where does that company make its money from? That's the really important thing to be looking at. Also, is it cyclical or is it defensive? So a cyclical share does really well when the economy's doing really well and doesn't do very well when the economy's doing badly. A classic example of a cyclical share would be a house builder. So house builders, when the economy's doing well, tend to go up. People are buying houses. All of a sudden, there's a recession. Everyone goes, I'm not buying a house. House builders sink. Or a defensive share. Is it the kind of share that should do well all the time, whatever happens? Now, some people would have said that a classic example of a defensive share was a supermarket, but I wouldn't say that they are at the moment. It's things like tobacco firms. Basically, people are always going to smoke. And you can still choose an investing tilt. So you might still want to go with small cap companies, but you have to be happy with that risk. So as a personal investor, and I'm not giving advice here, I'm just describing what I do personally, I'm more interested in investing in small to medium-sized companies that have the prospect of growth and also a strong balance sheet and pay a dividend as well. I think there's a lot of great companies out there, great UK companies that I can research properly that are doing that kind of thing. But I put some money into my portfolio going back last year, about April time, and I got unlucky. I bought at the wrong time, and the small caps did absolutely awful for quite a lot of last year. And on paper, I was down quite a lot. But I was willing to accept that because I'd made the decision that I knew that I was buying into stuff that was more risky and that there would be short-term the risk that I was going to take a hit on that on paper. And now, 18 months down the line, a lot of those shares have come good. Some of them were absolute dogs and I had to ditch them. But, a lot of them have come good. So you need to take your time. The other thing to think about is that it's not just about buying these shares, because people are telling you to diversify. It's about avoiding emotional behavior. Basically, we, as investors, we are tempted to sell at the bottom and buy at the top. That chart there is the FTSE All-Share graph. And what you will find is that basically a lot of people, when that's near the top, will have gone, everything's looking good, I'm going to buy. And then it sinks, and then they panic, it gets to the bottom, and they sell. And actually, they should be doing it the other way around. There's a study in the US called the Dalbar study, which is done every year. And basically, it looks at individual mutual funds, so basically investment fund investors over there, their performance versus the market, so versus the S&P. So if you're investing in a mutual fund, you're doing that because you think it's going to beat the market, right? So the simplest thing you could invest in is the S&P, the simplest, cheapest thing. Now, what they found was that the average mutual fund investor underperformed the S&P by 8.2% in 2014. And the average investor does this year in, year out. And this is not because of some dastardly conspiracy by the fund management industry to take lots of money off people. It's because basically people bought at the top and sold at the bottom. Rather than buying that fund at the start of the year and then holding it the whole way through, they dip in and out, and they time it wrong, unfortunately. It's ingrained in us, that ability to make those bad decisions. And what's interesting, actually, is that in this report, it showed that in 8 out of 12 months, investors guessed the direction of the stock market correctly in that month, yet still they managed to underperform. So one of the ways that you can diversify, if you do want to hold a shares portfolio, is to also invest in investment trusts, ETFs, and funds. These are an easy way to diversify. You can avoid home bias, and you can invest overseas. I mean, I don't think that many of us have the time or the money or the deep pockets to be going off and buying individual shares in a place like Indonesia or Brazil or somewhere like that. But you can very, very easily access an investment trust, an ETF, or a fund that will do that for you. And you can make these the core of your portfolio. So you look at your investment and you can say, right, I'm going to invest into these funds where someone is spreading my risk for me, and then I'm going to make my shares the bit on the side, the bit that I have fun with. So what's the final thing to look at in terms of diversification? Well, the thing I'd say is this isn't just a like starting out. You don't just do this at the beginning. You need to keep reviewing and rebalancing, and you need to look out for things that have become too big to fail. You know, beware stocks that become too important in your portfolio. If you get lucky and something does really, really well and grows to 20, 25% of your portfolio, then you need to look at that and say, well, is that now too much of my wealth? Am I too dependent on that one company doing well? Also, keep an eye on your asset allocation and check your diversification regularly. Be looking at your portfolio. And I would say don't be doing this every single day. Ideally, you want to maybe rebalance your portfolio once a year or once every 6 years. Oh, sorry, not once every 6 years. Once a year or once every 6 months at maximum. And then you'll give yourself the best chance of investing success. And by doing these basics, you then free yourself up to be doing that interesting stuff, finding those interesting companies, trying to find that winner that is going to make you a load of money, maybe being that lucky person who does buy ASOS or Google or something like that at the right time, but safe in the knowledge that you've not made a mistake in the background that means you're going to get absolutely hammered. Thanks very much for listening to me today, and that's the end of the talk.